Hard landing versus soft landing. What are the current odds of a recession? We're going to talk about durable goods and why they're forecasting trouble for the housing market. And we're going to talk about the hard landing versus soft landing scenario. What do those scenarios look like in history, and what does the market look like now? Starting off with durable goods, this was reported last week on a month over month basis, up only 0.1%. We can see it's a steady decline in durable goods. Again, durable goods is the sale of those items that are meant to last more than 3 to 5 years, such as appliances, automobiles, very closely correlated to the housing market, which we're going to see in just a moment. And there is a gradual decline. On a year over year basis, it's even more telling, down 1.5% compared to this time last year, following last month's report of 1.4% to the downside. We've spent more months in the negative territory than in positive over the past 6 months. Now, why is that important? Take a look in yellow, durable goods. This goes back to 2007, 2008. In blue, new homes sold. Those are the new home sales, the average sales price. In particular, notice in the latter part of '07, early part of '08, durable goods, again in yellow, was at 6.6%, 7.4% on a year over year basis, then went into the negative, while the average sales price didn't waver immediately, but then started to move to the downside quite rapidly, as we know, as the 2008 financial crisis ensued. Point being, there's a very strong correlation between the sales of, let's say, appliances and big ticket home goods and the housing market for obvious reasons. Where do we stand now? In yellow, new homes sold. Again, that's the average sales price for new homes. In blue, durable goods. Durable goods is in the negative area, 1.5% this month's reports. Now, the average sales price for homes is still resilient, in part, obviously, due to a tremendous amount of inflation. But the underlying fundamental foundation, such as durable goods, we can see that's beginning to deteriorate. Durable goods is showing us trouble in terms of the housing markets. Now, last week's data, it represents a real key moment in the economic calendar. We're trying to figure out, are we going to have a soft landing or a hard landing? In terms of the GDP, this was reported last week, up only 1.4% for the quarter. That's the final announcement, following last quarter's 3.4 and prior to that 4.9. We're seeing a gradual decline in growth. Now, a recession is classified as 2 consecutive negative quarters of GDP. 1.4% is still positive, but it's nothing to celebrate. On a month over month basis, we also reported the PCE, personal consumption expenditure. That's our measure of inflation. In fact, it's the Fed's favorite measure of inflation. That was down on a monthly basis, a little bit below 0.01%, following last month's 0.3. On a year over year basis, it's in positive territory, but only to a small extent. It's up 2.6%. Now, the Fed has a 2% target. They said they're going to start cutting interest rates when the inflation is sustained around the 2% level, around, because it's not, written in stone, so to speak, at that specific price level. But we are moving in the right direction, but we're still far enough away where the Fed's not going to cut rates. Now, putting all this together, what does a soft landing look like? And we'll give you a hint. It's when growth, such as GDP, and prices, such as inflation, PCE, they decline relatively at the same pace. They decline together. The economy doesn't fall apart. In yellow, and this is an example, by the way, of a soft landing. This is when the economy slowed but did not crash. This is in 1995. In yellow, gross domestic product. In blue, PCE. And we can see the PCE, the rate of inflation, 2.3%. At the same time, GDP slowed to 1.4%, where we are now, actually, 1.2% in the next quarter. The growth level, the measure of growth, GDP, gross domestic product, did not go negative. That is a soft landing. And we know what ensued afterwards with low interest rates was a tremendous bull market and a tremendously strong economy. What does a hard landing look like? Well, that's different. That's when growth collapses much faster than prices. That's when the economy collapses while inflation doesn't go down as much. The best example of this in recent history is 2008. We can see in yellow, GDP was down in the 8% area to the negative, while PCE 2.7%, almost where we are now. Notice the divergence, notice the separation between negative 8% GDP and a positive 2.7% PCE. Because you have such a difference, because the growth, the GDP, which shows us the strength of the economy or lack thereof, because that moved down so much faster than prices, well, that really shows us it was a hard landing. Where are we now? Well, in terms of gross domestic product, we know the latest results 1.4%. In terms of PCE, 2.6%. So we'd ask you, chat into the comments, let us know where you think. Are we on the path for a soft landing or a hard landing? And I'd preface that question by saying we're not asking about the pain of inflation, which is something we really want to talk about in our subsequent videos, is how much the rate of inflation is really making life very difficult for the average consumer and business. But that's not what we're talking about here. We're talking about the definition of a hard landing or soft landing. What's the divergence? What's the difference between growth expressed in GDP and inflation expressed in PCE? Let us know what you think. Now, what are we watching now? Do we have to wait for the next GDP report or the next inflation report? Not necessarily. We can look at the next big number, which is only a few days away. Non-farm payrolls. That's in blue. In gray, gross domestic product. Now, if we see a soft landing scenario, we would see growth that comes down and the non-farm payrolls or the rate of employment that also declines gradually. They move together. But if, for example, we see that the jobs market really falls apart while inflation remains steady, while the GDP that would decline, but maybe doesn't move as much as non-farm payroll. If the employment situation falls apart a lot faster, especially compared to PCE, that would be a sign of a hard landing. We're going to get our next clue into the non-farm payroll and the state of our economy in just a few days from now. Last month's GDP or last quarter's GDP, again, was at 1.4%. Last month's non-farm payroll, 272,000. The prior month was actually quite low. 272 is a lot better. The real question is the next month's employment number going to be good? I would say good is at least 200, 250. Anything above that is a good report. If it's a good report, I think that leans us more towards the probability of a soft landing. If we see the non-farm payroll somewhere in the hundreds, 100 to 150 in that area, maybe we're looking at the prospect of a hard landing. With that said, please visit our new Substack newsletter, The Many Sides of Inflation. It's our new publication within our newsletter. And we talk about many different signs of inflation in areas they may not initially suspect. And I think that you'll find what we discuss here to be quite interesting.